we're not going to do that this time.
Well, that's
All
positive
right.
anyway.
All right, so I'm going to show you what I came up with here. And I had originally gotten into the finance world as a debt management consultant. All right, and I was working for a company that are we shared right now? Or I was trying to. Oh, okay. I'm trying to share screen. There we go. There we go. All right. There we go. All right. And so, did I just lose you? Let's see here. Where'd you go? Okay, it says you got a camera resolution issue here. All right. Let me okay, so share the screen. There we go. Has an extra step in there. Holy cow, look at that. All right, let's see if we can get this up here. All right, so this is, I got out of the military and my income dropped off significantly. Every time I wrote a resume, came up something carrying a gun. It was like a 3-month wait for the police academy. I wasn't making enough money to pay all my bills, and my wife was like, the creditors keep calling. I go, well, tell them I'll pay them when I get the money. And she said, but they don't listen. I'm like, well, tell them to pack sand. Well, she couldn't do that, so I did it. And the guy from Discover Credit Card was a former Marine, and he was a little tougher than the rest of them. And he said, I think you should educate yourself on personal finance and debt management. So I did. I started reading every book you get your hands on personal finance and debt management. And I learned some things, and I applied them to myself, and I got myself out of debt. And using a debt roll-up strategy. I didn't even know how to use Excel. I had a whiteboard behind my bedroom door with all my debts on it, the highest debt to the smallest debt, my balances, and the monthly payments. And every time I paid my bills, I'd erase the old balance and replace it with the new balance. And I did a debt roll-up for myself, and I got myself out of debt. And then I still wasn't making enough money, and I started looking, and I saw an ad in the paper as a debt management consultant. And it was a group interview. Guys way more sales experience than me, mortgages, real estate, P&C, life and health. And it's like 7 of us there. And the guy that gave the presentation, big guy, like 6'9", he's a professional volleyball player, and real charismatic guy, though, good presenter. And he said, we're a debt management company, and we put everybody into a debt roll-up. Well, I knew what that was. And we help them. We have a relationship with a subprime lender. If they have equity in their home, we'll do a strategic refinance with a second mortgage or a new first, and we will pay out strategic debt that's going to create the largest margin of savings and add that into the debt roll-up. And then we'll apply consumer credit counseling and debt settlement strategies. We'll get you completely out of debt in 5 to 10 years without increasing your monthly payments. And I could read everybody's mind. They're thinking, that sounds too good to be true. But I'm like, from what I read, I think that's possible. So I got busy. Long story short, I wrote more business for that company than anybody had done for a year and a half. And my first month, and they made me the manager. And every time I showed somebody how to get out of debt, they started looking at buying a house. So I got my real estate license. I started doing mortgages and real estate, and they started to come up with these option arms, the pick-a-pay loans. You know, your three choices. You have the neg am 1%, and you're not paying enough to actually cover the interest, so it gets added to the principal balance after the 13th month. Then there was interest only, where you go nowhere in your principal balance, and then there was the fully amortized rate. And everybody wanted to, you know, I would show people how to, the disclosures, the truth in lending, and show how that 13th month, that recast, and where it's going to add to the balance, and then a higher payment with interest only, and they'd talk them out of it. And then they came up with the no income, no asset verification loans, and I just thought that was trouble waiting to happen, and I was right. And so I started doing construction lending. And those were bigger deals, a lot more pieces of the puzzle put together, but I could handle all that. And then that construction industry got hit, and I started doing commercial lending, and that was like feast or famine. You know, like I'd say it's like fly fishing for killer whales. If you land one, you eat really good, but you lose a lot of them. And I would go to events and seminars to meet people and network, and that's where I ran into the financial services industry. And I did that the way they were marketing for quite a while, and then I switched companies, and they started talking about these banking strategies. They have different names, from family banking strategies, personal banking strategies, to infinite banking strategies. They're different names. They're the same process. And so they were telling me, because of my background as a debt management consultant, that you know, this is perfect for my people. And I just really wasn't understanding why until I started talking to, we'll talk about how I got started, but my evolution, it took me a bit to get to embrace some of the products. And some of the things I was told about some products was not correct. So we're going to address some of that. But I'm going to talk about how it's possible to pay off somebody's mortgage in 5 to 7 years, 5 to 10 years, without increasing their monthly payments, without using consumer credit counseling and debt settlement strategies, which will cause a mark on your credit. And then we're going to use an example of a $250,000 mortgage at 7.5% interest. The monthly payment's going to be $1,748.04 a month. Over the term of the loan, you pay $379,293.06 in interest. Total amount repaid with the principal balance $629,293.06. You'd be paying for 30 years, 360 months. Payoff date would be July 2054, and your average effective, your effective annual interest percentage would be 7.76. So how is it possible to pay these off in less than 10 years? Well, if you use the pill method, so that's where you take the amount of principal. So the way these mortgages are amortized, in the beginning you're paying all interest and little bit of principal. In this situation, out of that $1,748, there's going to be like $190 goes toward principal every month. But if you just paid that principal amount, that $190, all right, at like the 11th day after your due date. So if you're due on the 1st and you pay it on the 12th, you'll knock out a whole month's worth of interest, over $1,500 worth of interest, and you'll pay that mortgage off in 15 years. Okay. Then there's the bi-monthly payment, where you're paying one more payment a year. So you split up your payment the 1st and the 15th of the month, and you'll actually add one more month's worth of payment to your loan every year, and you'll pay that off. You take about 25% off the time paying that off. And then there's a debt roll-up strategy. Now, that doesn't work if you just have a mortgage. Now, if you have other debt, credit card debt, car loans, student loans, right? This can be pretty effective. What happens is like that's what I did for myself. You pay off the first debt, and you take that debt service amount that you were paying to that first debt. Now you pay it toward the next largest debt, and everything you pay above and beyond the minimum goes straight to principal, lowering your effective interest rate, paying the loan off faster, and you just create a snowball of money, rolling it up and paying everything off. That can be very effective if you have other debt. And then there's the HELOC strategy, and we're going to talk about that a little more too. All right, and that's where you have a home equity line of credit, which is going to be simple interest, and you borrow from the home equity line of credit on your property. You pay your mortgage, your first mortgage with that amount, with that loan, that borrowed money, and then you pay that HELOC back every month, but you keep doing it. You're reusing those same dollars, okay? But there's some issues with that, and it's not going to pay it off any faster, and you're just not paying compound interest, you're paying simple interest. Okay. So and we kind of cover this, the personal banking, the family banking, the infinite banking strategy, the philosophy. What that is using financial leverage. You're leveraging an investment as an investment strategy of using borrowed money, specifically the use of various financial instruments or borrowed capital to increase the potential return of an investment. So you're leveraging assets like the home equity line of credit. That simple interest is adding another debt, but you get an interest rate tax deduction. Then there's people that, I just saw a whole video, a guy talking about borrowing from your 401k. Now, when you borrow money from the 401k, you don't earn interest on that money that's borrowed on that portion of the asset. But you can leverage your 401k to pay down your mortgage faster, okay? Or to pay your mortgage, okay? And then there's the whole life insurance. Now, we always thought whole life was bad, right? Doesn't get a great rate of return. You pay for your whole life. The fees are high. The money goes into the general fund of the insurance company. We were told all kinds of bad things about whole life, but in a whole life policy, you get a guaranteed rate of return, like 5%. And you do earn interest on that borrowed portion of the asset, and there's tax advantages that when you take that gain out of that policy, it's tax advantage. You don't pay tax on that money. And then there's the universal life, or the index universal life, or variable universal life. There's no rate of return on the borrowed asset in those types of policies, and they are tax advantages. When you do take that money out, it's tax advantage. You don't pay tax on that money. Okay, so you got the three different ways your money's taxed. There's the tax me now. That's going to be your bank accounts, CDs, individual stocks, mutual funds. You earn a rate of return. You're going to get a 1099. You're going to have to pay tax on that money. Then there's the tax deferred or tax later, which is the qualified plan. You qualify for a tax deduction on your contribution into these type of assets. That's going to be your 401k, your 403b, your TSP, your 557 plan. It's just plan. Certain limits you can contribute and take that deduction off the amount of contribution off your taxes. Low on your tax profile. The money's going to be tax deferred, so it's going to grow faster. But when you take that money out, that's when Uncle Sam's going to want his pound of flesh, and you're going to pay tax. And usually, you're going to end up paying more because that money grew. Then there's the tax me never. Okay, so this is the IRS code 7702 alpha. This is money in a cash valued life insurance policy. So the money goes into the policy. It's after tax dollars. It grows tax deferred. And when you take it out as a loan, and a wash loan. What's that mean? So let's say you get $1 million in a policy. You want $60,000 a year in tax-free income. You tell the insurance company they'll take $5,000 a month out of your policy, and they'll credit you 5%, hypothetically. That's just a number I'm using, right? And then they'll put it in the general fund of the insurance company, and when they pay you out as a policy loan, charging you 5%. So it's a wash. The credit covers the interest, but that's how you get out. That's how you don't pay taxes on loan proceeds, and it goes. So those monies that come out of life insurance contracts, either as a living benefit to live on, to pay your expenses while you're alive, and or your death benefit are all tax advantage. You don't pay tax on that money. That's due to IRS code 7702 alpha. Okay, so there's different kinds of life insurance. Okay, there's term. It's just pure insurance. The benefits is it's affordable, easy to manage. There is no cash value while you're alive. There's no complex tax implications. There's few restrictions. It lasts as long as you need it, as long as you, for that term, as long as you keep paying your premium. It expires. The drawbacks are it expires when the term ends, and there's no cash value while you're alive. So if you live, there's no financial benefit to you. Okay, then there's the variable universal life. It's a flexible premium. Your money goes to the insurance company. It goes into sub-accounts. They're like mutual funds. Your money's actually in the market. And when you die, your family gets the balance of those accounts. And if when you live, you can use that money to pay your expenses, to live on. But you're subject to the market. If the market's up, you're doing good. If the market's down, not so much. So when I first got in this industry, I had my Series 6, 63 license. I even passed my Series 65 exam, and it was all November 2007. The whole world collapsed. So all my clients that were in these variable products, they weren't really happy. They lost like 39% of their money, and they canceled their policies. Now, the market came back. If they would have left their money there, they would have got their money back. But I had all these chargebacks. So, I was like, So I've always been really careful about putting anybody into a permanent policy if they didn't have a cash reserve. They didn't have an emergency fund. Okay. And because I didn't want that to happen. I didn't like chargebacks. But that's the negative side of the variable universal life. Okay. Then there's something called the index universal life. Now this graph here I'm showing you on the top, it shows there's the fixed like whole life. Okay. You're going to get a certain amount for the whole period of time. Then there's the variable where you're up and down with the market, and then there's the index, and you can see the red line stair-stepping up. Hitting the high points of the market. There's a floor with these index funds between 0 and 2%. And so you can't lose your money. There's usually a cap between 8 and 15% depending on the carrier. One of them, after like 5 years, the cap goes away completely, right? But you actually can make more money, or your money does better with these index funds, even if you have a cap, because of the floor. 0 is the hero when the market's down 36%. And then there's whole life. Whole life, you got a fixed premium. You got to pay for your whole life. That's what they call a whole life. It goes to the insurance company, and it accumulates cash value. And then if you die, that money goes to your heirs. Okay. The benefit of the whole life is there's you're covered for your whole life, and you get a rate of return on that borrowed money. So the VUL, you get the market risk, and the index universal life, there's no market risk. You get the partial market gain. There's no rate of return on the borrowed money, and that's the key here. Okay, so if you want to if you're going to pay off your mortgage in a lesser amount of time, you want to use the whole life policy. So I've done all the calculations with the debt roll-up and with the pill method. If you were to the best I could ever get somebody was out of debt in 10 years. In this situation, just with the mortgage, without incorporating the other debts, if you had other debts, things would look a little bit better, okay? If you had a $250,000 mortgage, $1,748.04 a month paid into your whole life policy, then you borrow that money out of the policy to pay towards your mortgage every month. So it never accrues because you're paying it back every month, and you're knocking down your mortgage. At the same time, you're building in your policy. You'll take that 30-year mortgage down to 9 years and 2 months. Okay, so instead of paying off, July 2054, you'll be paid off in June 2034. Your effective interest rate goes from 7.76% to 1.6%, doing it this way. And what you're doing is, at that time, you're going to have enough in your policy to borrow from the policy to completely pay off your mortgage. Now you're paying yourself back. CDs used to do this. My dad turned me onto this concept. My dad put his money in CDs. He was a farmer. He was so tight that he squeaked. And he would borrow money from his CDs at 4% interest, and he'd pay himself back. He taught me the difference between good debt and bad debt. He said, credit cards are bad debt. The interest rate's so high, the payment's so low that you never pay them off. Good debt was like if he wanted to buy a piece of equipment like a tractor or a combine, because it was smarter to work and save to buy that piece of equipment cash, or with inflation, would just keep it this far out of his reach. If that was the case, he'd finance that piece of equipment, put it to work, make more money to pay that loan off faster. And he'd say, you got to think of yourself as being in the egg business. Your money's your chickens. You don't want to eat your chickens. And he would borrow money from his own CDs to do things like that. And that's why, and so you can't do that with CDs anymore, but you can do it with whole life insurance. All right. Now, this is an example. This is a $763,083 initial benefit. It's an increasing death benefit on a whole life policy. This guy's 52 years old. All right. And at age 70, so he's going to put over the term of this policy, all right, he borrowed $1,471,508 from the policy. Okay, and one of those examples was paying off his mortgage. I think he had like a $482,000 mortgage he paid off, and he had a cash value. At age 71, his death benefit was almost $2 million, $1,981,414. That's when he stopped paying the premium at age 71. Okay, at age 81, he's paid off the debt. He's paid off the loans against his policy. His death benefit is $1,691,818, but his cash value is $1,238,668 in cash value. All right, so that is an example of a real situation. Okay, if you could look at these. So he's in year 7. Year 7 of this policy, he would have had. Now he's paying $4,000 a month into this policy. Okay, this is a little bit bigger policy than what we were talking about for this, but this was a real case here. At year 7, his cash value is $279,801. All right, he would have had enough, to pay off the mortgage, and well, his mortgage he could have totally paid off. Well, he did it. He did it at what year? 1, 2, 3, 4, 5, 6, 7, 8, 9. Year 15, he paid off his mortgage. Okay, without putting extra money into the mortgage, he paid it into the policy. So that's an example of how the see, how do I get out of here? There we go. That's an example of how using the policy, a whole life policy, can be get you pay off your mortgage in a much quicker time, and at the same time building an asset for you. So that was my explanation. What do you think, Tom?
Coming from the background of financial services, I've been exposed to these concepts, and I've used a combination of different things myself to be debt-free. I've never used my life insurance. I've always bought straight term insurance, level premium, but I've used other methodologies to pay down my personal debt, and then, of course, my mortgage. Refinanced a 30 to a 15, and then accelerated it with discretionary income to pay off my debt, pay off the mortgage.
Well, that was this was an enlightenment to me. I was like, how do you do that? That for years, for decades, I've been beating my mind. Whole life is bad. But the thing that makes that change that for me was the ability to still earn a rate of return on that borrowed money out of the whole life policy. I never realized that until very recently. Okay, and why even the guy that brought me into this new company has always been like, whole life's bad, right? And then now I'm like, oh, but look at what you can do with it, right? It because of that ability to borrow that money, and earn a rate of return on that borrowed money. And you're paying yourself back. It's like my dad did with the CDs back on the farm, right? Same strategy. It's not a new strategy. When you look at where did Walt Disney get the money to buy Disneyland from? He borrowed the money from his whole life policy. Did you realize that? So that's there's all kinds of things that Disney did. Disney used a trust strategy, to a land trust to buy the orchards that he built Disney World on, right? And I had a guy come to me, when 2008, and everybody's like freaking out about the mortgage loan crisis, and he was trying to get us to offer these trust strategies for people to sell their properties. Didn't really work back then, right? Because why would you want to do that, right? You'd be subject to the existing loan. Basically it was an owner finance strategy. It's actually would work better now because of the low interest rate people had all these years. These low fixed rate loans, you can't get those loans anymore. It'd be more advantageous to find somebody looking to get out of a property in distress with one of those type of loans to do the trust and get subject to the lower interest rate, the under 4% rate, than what you'd pay right now. Those kind of things. But there's stuff that's been around for a long time. Al Capone used trust strategies to hide his assets from the IRS. That's how he did it, using a land trust to buy his properties. But there's all kinds of things that have been around for a long time. This is a strategy that's been around for a long time, but not a lot of people understand it. And so what you're doing, there used to be a company called World Savings, I don't know if you remember them. They had the
Yeah.
pick-a-pay loans.
Yeah.
They would allow you to do, the only way you could do 100% financing with them is if you had assets. You had stocks, bonds, mutual funds, you had CDs, whatever, right? You could pledge those assets for the down payment on a property. 25% down is what the number was. If you get enough assets to pledge 25%, then they would finance the rest of it. Okay? So your money still stayed, it was still your money. Okay? And when you got that money back, either when you paid down enough on the mortgage or the equity in the property went up enough where it covered that, then you got then it was secure. It was held into an account that earned interest, and but they would give it back. That pledge money, they would basically just release your money. Okay, but it's a similar strategy. You've got these assets in your policy that you can borrow from, still earning a rate of return, and you're paying yourself back. That's what this strategy does. So I wanted to cover that today. I mean, it was enlightening for me to have a good understanding of it. I'm going to be doing things like this. There's a couple things I want to talk about down in the future is these synchronistic business strategies where you own multiple businesses that support each other. Okay, like U.S. Steel. U.S. Steel started off with the production from Carnegie Steel. They had the mills that smelted the ore, and then they basically went into business with the people that made railroad ties and railroad cars and ships and barbed wire and telegraph wire. All right, so they had the distribution too. Okay, so all these different businesses, they were all supported. It was a hub strategy for a business. Okay, so we're going to talk about that and how this type of strategy can help somebody do that. And so that's another thing we're going to discuss. And then so there's all kinds of little strategies that I've learned about over the years that people aren't taking advantage of. Like I said before, we in this country, we have to get 880,000 people right now that are living off the public dole. They're living on Medicare, Medicaid, Social Security, their government pensions, military pensions. 880,000 of them have to replace that with a sustainable income of $50,000 a year, either from a business or their investments or a combination of both. And we have less than 8 years to make that happen, or every cent in the federal budget is going to go toward paying those entitlements. We're going to become a socialist country. And we have to get it, help everybody wake up and understand that there's things that they can do and that they need to do them, or we're all going down.
I agree. Yeah.
I joined the military because I was so upset when in Tehran when they took over the U.S. Embassy and held over the 100 Americans hostage. I was going to join the military and I was going to get some respect for our country. Right? That sounds really naive, but there was enough of us that joined at the same time that actually made that happen. On my watch, there was a lot of. The wall in East Berlin came down. We beat back I was part of helping them beating back the communist guerrillas in Peru, the Sendero Luminoso. Nicaragua became a democracy. The war in El Salvador ended. We got Saddam Hussein out of Kuwait. All these things happened on my watch people that were like-minded people, and that's what has to happen. There has to be, there's a, what's that term called? A zeitgeist created, a mindset of the age, all right? And we need to make this type of thinking getting people to understand what they can do. You know, I'm going to talk about how to take somebody from nothing, or how I go and I analyze somebody's finances to see where they're at, and I get busy to help make it. It doesn't matter if they have nothing; they're just getting started, and they're getting help get a $15 an hour job, and then start a side gig, within a couple months, and then it increases. It's making half again as much as they were on their job, and then within a year they got enough to start a business, and then with that business, growing that business, creating, using this synchronistic business strategies to invest in businesses that support their primary business, and to get them to the, like Jason Cisnero likes to talk about, the build to exit. They're building their business to either be able to sell it, or that get them under the right management so that business will produce for them whether they go to work or not. It's just a cash machine.
Yeah.
Making money for them. So those are the kind of things we're going to talk about.
Cool. People need to understand that the value and the benefit of being in business for yourself. And there's so many different ways to go into business. Everything from traditional brick and mortar businesses, your trade, your whatever your talent is, putting that in the marketplace, to investing, you name it. But I've been a big proponent of being in business for yourself since 1983. There's only a few stints in that period of time that I've actually drew a paycheck from somebody else's effort. So
yeah, when I started my website, MyBusinessIsYourBusiness.info, over 10 years ago, my original strategy is if I had business clients, I'd promote their business on my website, and if they made more money, they had more money to invest with me, right? Well, it just never happened, right? So if you go to their website now, I got these infinite banking strategies, talking about the be your own bank, family banking strategies, the synchronistic strategy for the hub strategy for businesses, the multiple businesses that support each other strategy, right? And then, but there's also Gusto, which does business administration. They do payroll administration and the HSA administration. I don't make any money out of the HSAs, the health savings accounts, but that's the one financial strategy. You get a tax deduction on your contribution. It grows tax deferred if you get any growth on it, and when you take the money out, but you have to take it out for medical expenses. But there's no tax anywhere in the process. Contributions, growth, and when you take that money out, that's the one financial vehicle where there's no tax at all. That's the only one, right? And then there's Score Navigator. That was the guy that actually created the credit scoring system for the credit bureaus. I chased that guy down for 4 years. He's got a consumer dashboard. So for $50 a month, you can manage all 3 credit bureaus. If you want a 700 FICO score, 720 FICO score, whatever, it'll tell you exactly what you got to do to get that score up there for $50 a month. All right, and there's the NACA link. I don't make any money off of that, but that's you can get a first-time home buyer can get into a house, 100% finance, up to a 4-unit property, 100% financing. They don't care what your credit score is. They want to just show that you have 3 years income. So you have to have 3 years tax returns showing income, and they'll help you get into a property, 100% financing, no down payment, no closing costs, with a better interest rate than the conforming loan rate. So those are all the things that you can find on, MyBusinessIsYourBusiness.info. And I created that to help small businesses. I like, small businesses. I help them with their 401ks, their profit sharing, cash balance strategies. They take a lot of time. A lot of people don't want to do it because it takes time. There's some pieces of the puzzle you got to put together, right? But in the process, I can do other things. I can roll over from an old 401k from a previous job from their employees, or they, get them a permanent policy, a cash value life insurance contract, with these infinite banking strategies, right? And so there's other business that I get out of it, right? Because I've helped them, because I'm, I can take them down the path, and I got great providers. Basically, they do all the work for me. So it helps me out a lot, right? I just have to find the person that needs the service. So that's what I do.
Cool. Yeah. With my ventures is something I just recently ran across. I thought I'd just share this with you. Is give to profit is how businesses are really growing and accelerating themselves. They put in strategy of their sharing with their market, their customers or their clients, whatever the case, what they back on giving, and it dramatically improves loyalty and profits by expressing one's giving strategies in their business. So I'm implementing that myself. I let people know that 50% of my profits go to 4 different causes. And so I'm building an alliance of people that are of like mind, that want to support those entities by doing business with me with my products or services. So it's sort of a win. So I'll be doing some podcasts on that give to profit business strategy here in the future. So
yeah, let me know. I'll join you.
Okay, will do.
I appreciate your support a lot. I really do.
Okay.
All right.
Well, people need to know about the strategies you just shared with them, with us. So encourage anybody out there to take that step, take a look at what it could mean for you in creating that place of being financially free, financially independent. So
yeah, I appreciate your endorsement.
yeah.
I mean, and a lot of it is just like breaking old paradigms. I mean, I stayed away from. I would use a whole life policy only for covering end of life services. Paying for the funeral. Those little. Not a lot. Maybe a $20,000 policy, right? To because a lot of them are real liberal as far as their underwriting. Somebody can be older and get that. It's affordable, right? And it's but that was all I'd ever used whole life for. Right? I was never looking at it for anything other than that, because I didn't think it was the right vehicle until. But that what makes it sexy is that be able to earn that rate of return on that money that's borrowed.
Yeah.
And that you can. So that's, because the other vehicles you can't do that. You're not going to be able to knock that debt down as quickly, and you're doing it because it's growing in your policy. That it's that same money that you're putting into the policy, you're just paying off your debt, and so because it's growing, at a certain point you have enough in your policy to pay off your mortgage, and then you're paying yourself back. Yeah. So that's how that goes. All right. Well, thank you very much again, Thomas, for your support, and let me know when you got a podcast, and I'll come on and support you.
Be glad to. I'm going to be doing a whole series on give to profit as a business marketing strategy, how to grow your business with that principle of, because 86% of consumers today expect companies to do more than just make a profit. They want to know who you're associated with, who you give to, those type of things. So it's different as well. So I'll be sharing that here soon.
All right. Well, thanks again, Thomas. I love your support. I appreciate it very much.
All right, bud. God bless.
Bye-bye.
Take care. Thanks
Bye-bye.
for your service in all ways.
Bye.